Get ready for more valuable financial insights from Northern California's premier retirement income planners, Dan Ahmad and Jim Files, owners of Peak Financial Freedom Group. For more information, go to peakfin.com. And now, here's Dan and Jim.
I'd like to welcome you to the Peak Financial Freedom Hour. I'm Dan Ahmad with my partner, Jim Files. We'd like to thank everyone for listening to our show. Some of you are new listeners, so welcome. Some of you have been listening for weeks, months, years, even decades. So it's kind of nice to have you here, and we're always here to provide information, share ideas, help you make better decisions with your money. If you'd like to meet or just have questions, dial pound 250 on your cell phone and say the keyword money. That's pound 250 and the keyword money. You can also go to our website and listen to our podcast, which will be all of our previous radio shows. You can also go to our YouTube channel and watch our TV show. And it's not just an infomercial. Every time we film a new season, we do 13 new shows. So a lot of data there. And we've been able to help many people, thousands of people, learn how to make the best decisions with their money. And we hope we're helping you make those decisions. Jim, why don't you start with maybe financial wisdom quote of the week or quotes of the week?
Yeah, this comes from Fred Rogers. It says, often when you think you're at the end of something, you're at the beginning of something else. And I think if you're getting close to retirement or in retirement, if you haven't asked this question of yourself, or if you're married to your spouse, you have finished what we call asset accumulation, whereby you've been taking risk, you accepted volatility because you were trying to accumulate or grow your assets so that when you retired, you could use those assets for income, right? That's what we save the money for in most cases. Now, all of a sudden, you're at the beginning of something else. You're getting close to retirement or you're in retirement, and you have to figure out how to preserve those assets against large losses, because at some point in time, you're going to use those assets for income. And these are distinctively two different stages of retirement planning. And this quote is perfect for that, Dan. So why don't we talk about asset accumulation, and let's talk about then what happens when somebody retires and they go to asset preservation.
Well, that's perfect, because this fits into what this show is titled. It's called Going Against the Grain, because while you're accumulating assets during asset accumulation, when you're working young, making a salary, you will do one thing to give you the highest possibility of success, which is to grow your assets as much as possible without regard to how much risk you're taking. Now you have to go against the grain. You have to shift and do things exactly opposite of what you did to be successful getting here. And all of our clients have been successful getting here because they save. They don't overspend. They'll spend money, but they don't waste it. They don't want to suffer big losses, but they have taken risks to get here to get a better rate of return. At retirement, though, we are now in asset preservation and income distribution mode, which is completely different than asset accumulation mode. Asset preservation against large losses and income distribution mode says just what it is. We have to put a plan together. You have to. You don't have a choice. You have to put a plan together to reduce your risk against large losses. Otherwise, you have a high probability your retirement plan is not going to work if you're going to plan to take a decent amount of income off your assets. If you don't need any income, you can take as much risk as you want, and it's not going to matter because the assets can lose 50% and it won't hurt you. We want to make sure we help transition you into asset preservation against large losses and income distribution, because that gives you the highest probability your money will not run out for as long as you live, but also gives you the highest probability you'll take out the highest level of income, Jim, you can for as long as you live.
You know, people sitting here today, the market's gone up for the last 17 or 18 years since the Great Recession that we had during the financial crisis, and people become so complacent with their assets. But you got to look at your age, and are you getting close to retirement? Are you in retirement right now? Go back to 1999. Imagine yourself in 1999. You're 65 years old. You've been riding the market up for 8 or 9 years, and everybody's talking about the possibility of this internet boom that's just about ready to happen. And it started happening in 99 and 2000, that the market's never going to go down. Well, what happened between 2001 and 2, the market dropped 53%. That's the S&P 500. The NASDAQ dropped 68%. So if you had $1 million in the NASDAQ, you're down to $231,000. And you look back to yourself, if you were getting ready to retire, and you say to yourself, how could I have made that stupid mistake? I saw all the signs on the wall, and I just kept on going for it. My advisor says, stay in it, don't get out no matter what. And I lost half my money, and you just started to retire. Now, fast forward, go 7, 8 years later, 2007, 8, and 9. Let's assume you retired during that time frame or getting ready to retire. And the same thing happened. The market started booming again. Everything was going up. All of a sudden in 2007, the market started getting wobbly. By 2009, the S&P 500 was down 57%. So if you had $1 million, you're down to $430,000, just like you would have been during the tech bubble. And how do you think you would have retired during that time frame? And do you think that happened to many people? And I can tell you it happened to tens of millions of people. And Dan, it's going to happen again.
Well, people come in all the time. In the last 6 months, people came in, and I'd say probably 50 people told me that I went through two large market declines, 2001 and 2, 2007, 8, 9, lost it, made it back, lost it, made it back. And overall, I've earned a modest rate of return, but nothing compared to what I'm always told I'm going to earn, because a lot of the rates of return were simply used to make up for all those losses that they have. So people realize it. And you have to think about, when does the market take a big dive? When it hits the highest point. Well, right now the market's at some high points. We know it will take one of its inevitable dives. We just don't know when and at what magnitude. It'll dive and then it'll recover. The problem is, at retirement, you cannot be in that mode to allow your assets to take a dive right now. You don't have time on your side. You're not continuing to save money in your 401k. You need to use your assets for income, which are all warning signs about keeping your assets at risk in the market without any type of protection. So it comes back to what I said earlier, Jim, going against the grain, because you saved money your entire life, and you saved and you saved, you did without, you were frugal, you didn't waste money, you spent money, but you didn't waste it. And you build it so that 30, 35, 40 years down the road, you'd build up a pile of money so you didn't have to worry about your money anymore. That's really one of the main goals most people have. Save enough so I can retire and not have to worry about it. Well, I've found very few, if any, people that are getting ready to retire, retired, that has saved money, even if they saved 2 million, 3 million, 4 million, 5 million, $6 million, that now can say they worry less about their money at retirement than they did while they were saving it. Every single one of them worries more about their money, because they know they're probably doing the same things with the money as when they were 30 or 35 or 40, and they know they shouldn't be. They just don't know what in the heck they're supposed to do to get out of that mode.
Yeah, and they keep on being taught by the internet and by the talking heads on these different financial shows that the market will always come back if it goes down. And guess what? We agree with that. The market, we believe, will always come back if it goes down. Look at history. But how long will it take to go down to hit the bottom? How much money will you and I lose if we're not positioned correctly? If we're drawing income out of those assets now, which we weren't doing when we were working, what happens to that drawdown on the value of your account? How long does the market actually drag on the bottom before it starts to go up? How long does it take to get back to even? And when you're looking at those time frames, typically when you have a drawdown of 30 or 40% in the market, typically it takes from 1.5 years up to 19 years to get that market back to even. Look at the NASDAQ. It went down in 2000, right, by 68%. It did get back to even 19 years later, Dan. This stuff happens. And if you have a retirement, you're not going to live 35 years in retirement. If you retire at 65, you're going to live probably, I hate to say this, but probably 20 years, maybe 25 years, maybe 30 years. But you better be careful. It took you 35 or 40 years to accumulate these assets. You cannot risk all of them at such a vulnerable point in time where you're getting older.
When it just goes again to going against the grain, you have to put different parameters, different strategies in place. And in many cases, you have to use a different advisor, because advisors that are really good at helping you grow your assets, helping you take risk, helping you to stay the course, helping you to get the highest rates of return, they are not the advisors that work in asset preservation against large losses and income distribution. We're really good at what we do. We can't do both. So if someone comes in and says, hey, I want you to help me grow my assets at the highest rate possible, I'm not worried about risk, I don't need them for 20 years, we'll just tell them we're not the right planning firm for you. It just doesn't fit. If retirees or pre-retires come in and say, hey, you know what, I'm either retired or looking to retire in the next couple of years, I've saved a decent amount of money, I don't want to lose a big chunk of it because I know time's not on my side, and I really want to find a way to put a plan together that'll show me how I can use my assets for income and feel comfortable that it'll never run out for as long as we both live, feel comfortable that we're not going to get killed in taxes, and feel comfortable that we possibly can still leave some money down the road to our loved ones. And that ends up being what we focus on. And we're one of the few groups that we've found that says this is all we're going to work on. So we have a very skinny group, but the skinny group is probably you who's listening, people that are retired or getting ready to retire. The other group that we work with are people that have no idea if they can retire. They have no idea because they've worked their butts off. They've saved a lot, but they just don't think they've saved enough. They think they made all these mistakes. They think they have to get to this magic number of assets saved, but that's not how you find out if you can retire. You find out if you can retire by first creating your budget. Then we create an income plan based on the assets you have that will show if you can exceed your budget. So let's pretend like you think you can't retire. Let's say there's a client out there, Jim. They think they can't retire and their budget's $8,000 a month, and we create a plan that's going to give them $12,000 a month of net income after taxes. Can they retire?
Pretty good, right? Pretty clear. And the beauty about this is that if you're not retired yet, we can actually lay this out for the next 30 years and show you when you can retire. Maybe it's right now. Maybe it was 2 years ago and you didn't realize it. Maybe you're going to have to work a year and a half longer. But wouldn't it be nice to see the blueprint in front of you? And it's not just us taking 4% off your assets to get your income. That's not what we do here. We're using very specialized financial instruments, very, very sophisticated strategies to make sure we have the optimum chance of success in retirement. So we can lay this out, not just where your income's coming from by income source, but also if that income's guaranteed. Is it not guaranteed? Will it be there forever? Will it vanish? Then more importantly than that, we're doing after-tax analysis. In other words, how much you're going to owe in federal and state taxes, that gets subtracted out from your income source and said, okay, this is your net after-tax money. We know what your budget is. We make you do one. We know what inflation might be, so we increase the budget by that amount of money, and we can then tell you with a great deal of certainty when you can retire.
You're back with Dan and Jim, Peak Financial Freedom Hour. Thanks for staying with us. And we're talking today about going against the grain, which means making decisions that are different now than you would have made 20, 30, 40 years ago, or even 10 years ago. Because if you're retired and getting ready to retire, everything has changed on you. Of course, you're going to be retired or getting ready to retire, but everything has changed as far as how you have to view your assets. You can't take the same amount of risk inside of the assets if you're planning to use the assets for income. If you don't need it for income, you can take as much risk as you want because you don't need the assets. But most of the people we see, 99% of the people, they don't have pensions big enough to support their lifestyle, which means we have to use their assets to create income. And if that's true, then do we really want to, as we're advised by so many people out there, do we really want to take the chance that our income isn't guaranteed? Or do we want to guarantee that our income will never stop for as long as we live? And the overall goal is to make sure your income will never run out for as long as you live. You first have to focus then on what's the appropriate amount of risk for a retiree, pre-retiree. And you're going to hear different things. A lot of times you're going to be told by advisors, oh, don't worry, you're conservative, you're moderate, you don't have that much risk, but they never quantify anything. They don't put in writing how much you could lose if the stock market loses 50% like it did in 2001 and 2 or 2007, 8, 9. So you have to find out what the appropriate amount of risk is, and we will define that for you. So many people will not quantify things for you. We're going to quantify every single thing we do. The amount of risk you should take should never be more than 5% up to a maximum of 10% of your total portfolio, even if the stock market drops 50%. What does that mean? Let's say you have $2 million in your assets and the stock market drops 50% and you were invested normally, like most people, you might lose 50%, even if you're just invested in what's considered moderate S&P 500 index funds, which means you lose $1 million. We don't want you to be in a position, really, like 95% of our clients, to lose more than 5%, even if the stock market crashes 50%. So on $2 million, we still have a loss, but now instead of $1 million, Jim, we have a $100,000 maximum loss, which makes it a lot easier to plan and move forward and continue to take income.
You know, why do you think we talk about risk so much on our shows? Why do you think we talk about planning so much on our shows? Why do you think we talk about income requirements on our shows? Because we're only working with people that are soon to be retired or retired. So if you're 25 years old, you're not our client. If you're 40 years old, you're not our type of client. If you're getting close to retirement or in retirement, you are our prospect. You are our client. That's what we've designed our entire company around, is folks like you. And we do things differently here. And the reason we talk about risk and plans and fees and all that kind of stuff is because you better understand it. It didn't matter so much when you were younger, as Dan just mentioned, but if you lose a good portion of your money right now before you're retired or in retirement, it's going to be so stressful. You're going to say to yourself, how in the heck am I going to recover? I've worked 35 years to accumulate these assets, and now I'm going to retire in 3 years. How in the heck can I make up a 20 or 30% loss? And the answer is you may not be able to. And I can tell you,
I think it's the answer is you probably won't be able to.
probably won't be able to. And so you got to change up the game. You can't just listen to this radio show and go home and say, oh, it's going to be okay. We can help you manage through this. We can help you understand this. We can show you 30 years out each month and each year where your income is going to come from. We can tell you if you're going to be short. I met with a client last week, Dan, and we saw at year 17, they're 60, they retired early, him and his wife. At 17 years out, which is they'll be 77, they were going to be short on their budget about $3,200 the first year. Then it went up to $7,000 the second year. Then it went up to $13,000 the third year, meaning that I have their budget going up each year by 3% with, expected inflation, but their income sources weren't going to up enough based on the initial plan. So what did we do? We modified the plan. We actually sat down and we modified the plan. So now they're positive cash flow on an after-tax basis with excess cash flow above their budget for 30 years. And they feel great. It's done in advance. We don't wait for this thing to happen.
Well, I think there's a couple things to take out of what you were just talking about there. One is when you look at the people you and I get in front of, they've all been good, even great savers. They've saved $1 million, $2 million, $5 million, $8 million, $10 million. They've saved a lot of money. They've been good savers. But what's happened now is that being such good savers has kind of led the financial industry, their advisors to 401k people, to make them feel, and they keep telling them they now aren't savers, they're investors. And they think of their savings now as investments, when in reality, they save the money for the sole purpose to create income for retirement that would then drive the level of lifestyle they would have. So we have to go back to why we saved the money for in the first place. It wasn't to be a wonderful investor and make all these huge gains on NVIDIA, etc. It's nice that we do that, but it came down to these monies were needed because we're not getting big pensions and we need to use our assets for income. Now, when you look at what are the uses for our monies that we saved, there's only a few. And you look at that, either you need income now from your assets once you retire, or income later for emergencies, bad things happening, opportunities, good things happening, health or long-term care costs in the future. And if not, then all the money's passed on to beneficiaries. So those are all really good reasons and uses for the monies. The issue is, what's the only thing, Jim, that can happen that would stop all those things from happening?
Losing a lot of money, period.
Across the board. Why?
It'll destroy your plan. You lose a lot of money and none of those dreams are going to come true. You're going to be at catch-up mode. You're going to be a nervous wreck because you're going to realize that you don't have another 30 years to try to gain that back. You're getting close to retirement, or you are in retirement. So you can't make and I hate to say this, stupid financial mistake right now. You can't. You have to be smart about your money, and you have to have a plan in place to understand your money so that you don't make a decision that's going to hurt your future.
Well, think about it. Do people have to listen to us if they're not planning to use their assets for income now, if they're not planning to use their assets for income later, if they don't worry about using the assets for emergencies or opportunities, if they don't care about their assets for health and long-term care and don't care if the beneficiaries getting money, they don't need to listen to us right now.
Yeah, don't come at our office. That's not what we do, right? But how many people are like that? Not a lot, right? Maybe you've won the lotto or you have very wealthy parents.
Or big pensions.
Big pensions, right? Yeah, that's fine. That's wonderful. You're in an extraordinarily unique position, but that is not 95% of the client base out there. People are worried about the money. They're worried about the economy. They're worried about what if.
You're back with Dan Allman and Jim Files, the Peak Financial Freedom Hour, and we just ended talking about what you'll use your money for during retirement. And there's only a few things. So let's go over them again, because I think it's very important. You'll use your money to create income now because you need it because you're either retired or getting ready to retire. Income later, maybe you need even more money, income, to keep pace with inflation, or you have bigger costs down the road. If anything bad happens, you need it for your money for emergencies. And maybe there's some good things, opportunities for yourself or your kids or your grandkids. You might need it for health issues in the future, or more importantly, long-term care. And if not, we'll end up passing our assets on to beneficiaries. Those are the only things you will use your money for. And Jim, we talked about it earlier, that the only thing that'll stop these things from happening is if you suffer a big loss. So if these are the things you think you'll use your money for, you have to position your assets to eliminate big losses and preferably get down to that 5% risk level, which means even if the stock market crashes 50%, we don't want you to lose more than 5%. And we're going to put a plan together in writing that'll show that, because if you suffer big loss, these things won't happen. And then how is someone going to feel? Because you have to imagine these things happening before you can understand how they're going to affect you, right? So, and no one wants to think about that, right? Do you really want to think about losing 50%? No, but
No.
you have to.
No, you have to, because it has happened. People say, well, Jim, the market's not going to go down 50% again. Well, folks, wake up. In the last 25 years, it's happened twice. 2001 and 2, the market dropped 53%. 2007, 8, 9, the market dropped 57%. Do you not think, based on where the market is today, we believe, based on every technical analytical tool we have access to, the market is substantially overvalued. One of the tools that is developed by a Nobel Prize winner, he developed a tool called his Cape Ratio Analytical tool, and it's showing that there's only been 5 times in history since the mid 1800s, when the stock market started, where the market's been this overvalued, or even more overvalued today. And every single time, the Dow, the S&P, and the NASDAQ dropped between 20 and 89% every single time. So don't you think that's important to think about risk?
Well, think about also, we're saying don't trust us, just trust history and what's happened. I know a lot of people say trust history, that everything good will happen. You cannot bet your retirement on the best case scenario happening. If you do that, you are just waiting for something bad to blow up your retirement plan. You have to base everything on the worst case scenario, because if your plan works based on the worst case scenario, are you going to be mad if it's better than the worst case scenario? There's no way people will be happy and everything works. And that's why our clients don't worry, because we base it on the worst case scenario. Now, just based on what you're talking about there, think about where the market was in 1999 prior to the 2000 technology bubble crisis and where we're at right now. If you look at the graphs, they look eerily identical. Eerily identical in that price to earnings ratios back then were 22, 23, and they're there right now, which means we're probably 50% overvalued as far as where the market is. Technology had built up the value of the stock market in an irrational manner. What's happened now? We have a $17 trillion of AI buildup that we don't have accounted for yet. So the stocks have already made the money as if we've had $17 trillion of value. So what's that saying?
Well, it's a big issue too, because back in 2008 and 9, in the last financial crisis that we had, we had very little debt relative to what we have today. Would we have $5-6 trillion of national debt? We have $37.5 trillion of debt. And back in those days, in 2009, the Feds could come in and lower interest rates to basically zero to stimulate the economy. How can they do that again if we have another financial crisis and we have $37.5 trillion of debt? How are they going to add another $20 trillion to the balance sheet? They can't do it. They can't afford to do it. So,
well, here's my nerd question, my nerd thing to insert, and then you get to keep going. But did you realize that $1 trillion just sounds like a lot of money? Gazillions, bazillions, trillions, whatever you say. 1 trillion is 1 million millions. 1 million millions is 1 trillion. That means we have 37.5 million millions of debt. How does that make you feel in your gut?
That means that you and I don't even understand that, and neither does our government. Because in order to print new money, in order to get us out of a financial recession, their options are limited this time around. And I don't know if you ever listened to Ray Dalio. He ran the biggest hedge fund in the world. He's a very sophisticated investor. He came out last Thursday on CNBC and said this market is in for a rude awakening that is going to tumble significantly. He, like anybody else, can't tell you when it's going to happen, but the writing's on the wall, and people are going to get caught off guard, Dan. People are procrastinators. And I say this so nicely, there's ways to solve the problem right now. You don't have to get completely out of the market. That's not what we're saying. What you have to do is understand your risk, and then you have to choose how much risk you want, and then you have to have your portfolio modified correctly. And that doesn't mean just put more money in bonds. We're using different financial instruments. We're using different strategies to help you get a real reasonable rate of return, but more importantly, lower your risk significantly.
Well, there are 2 forms of greed, and this isn't the bad greed that you're being mean and stealing money from people and hosing people. It's just there's 2 forms of how you view your money. One form of greed is how you view your money is you want to make the highest rate of return possible, and you're really not worrying about risk as much because you're not planning to use those assets. That's one form of greed. The second form of greed is you've already saved a significant amount of money and now you don't want to lose it. So you have to decide which one of those types of views of your money you want to embrace. And we do a simple test to help you understand this. So if you're driving around, you can do this in your head. If you're home, just write it down. But pretend like you have $3 million of assets, and either you think you saved a lot or you don't think you saved enough. Just pretend like you have $3 million of assets saved for retirement. Now, if the stock market goes up 50% more, because it could, we don't know, it won't go up another 50%, it could. If your $3 million went up to $4.5 million, you'd be happy because you have more money in your portfolio. But what if there's an equal probability, which there is, that the stock market goes down 50% and your $3 million hits 1.5 million? Will, at this point, the $4.5 million enhance your lifestyle significantly? Or will the $1.5 million after the loss hurt what your lifestyle is going to be? And what does every single 100% of the people say? Every person we ask this says the 50% loss would hurt them significantly more than the 50% gain would help them. Welcome back to the Peak Financial Freedom Hour. You're here with Dan Ahmed and Jim Files, and we're talking about going against the grain today, which simply means the decisions you made while you were accumulating assets, while you're young, working, making a salary, contributing to your 401k, had time on your side. Those decisions you made there were proper, but now you have to make completely different, almost 180-degree decisions now at retirement if you're trying to protect your assets against large losses and create a high level of income that will not run out for as long as you live. And that's pretty much what people want. They just don't know that that type of planning can be done for them. Well, not only can it be done for them, it can be done in writing, so you don't have to trust someone. You'll be able to trust your plan. We create plans for people just like you, and we work with them. We give them their plan in writing. They take it home to review. They don't become our client yet. So they get to now have no pressure, no stress on them to view what could potentially be a plan. Then they get to decide, do they want to implement their plan based on every single little detail we put in writing. And if you like that, call pound 250 on your cell phone and say the keyword money, pound 250 and say the keyword money. So let's look at some other things about going against the grain. And I see this a lot, but what about when people are told, hang in there and ride out the stock market? Just one simple thing. They're told, you're in it for the long run. Hang in there, ride it out. Everything will work out.
Well, if you're 65, 60, 70, and you have kids that are 25 or 30 or 35, that's what you should be telling them.
The 20 and 25.
Exactly. You should be telling your children, hang in there, dollar cost average with your 401 contributions. And when you wake up 40 years later, you should be okay. And that strategy works if you're younger, you have less money, you're not getting close to retirement. But imagine if you were 65 and you were told to hang in there, write it out no matter what happens. Well, yes, when you're in 30s and 40s, the market went down. It did come back. Sometimes it took 5 years. Sometimes it took 13 years. Sometimes it took 7 years. But if you're going to use your assets for income, why would you want to hang in there and write it out? Why would you want to do that?
Well, because they're told to do that by many huge percentage of advisors saying, even if you're taking income off of it, you need to hang in there, write it out. Some of the biggest names in the 401k business use the Monte Carlo simulation and say, oh, don't worry. You can suffer a big loss like 2000, 2008, and you have a 95% chance you can take out 8% of your assets. You're never going to run out. I'm like, in what world, in what galaxy is that ever going to happen?
Yeah. Well, people don't understand. They don't do the math. And if you go back to 2000, let's assume you had money invested in the S&P 500 index, right? That means, let's say you had $1 million in that index.
In the S&P, that's considered by a lot of people to be a moderate index because it's the 500 largest companies squished together in one. So you think it's diversified and has not that much risk.
That's right. So let's say you were told to hang in there and write it out. Let's say you're 65, you just retired, and let's say you had $2 million in the S&P 500 index. Well, by the time you hit 2003, that $2 million had dropped by 53%. So now you had what's that, $930,000, okay, approximately. Your $2 million drop. That's assuming you didn't take any income off that asset. Imagine for 3 years, you're taking out 5% a year. That's 150,000. Now subtract the 150 from the 930, and when you're down to 8 with that 850, 860, all of a sudden you say, what's happening? Well, you call your advisor. He tells you to hang in there, write it out. It's going to come back. And he was right. Over the next 5 years, by 2007, the market was back to even. But
Well,
remember,
when he said hang in the ride it out because the market will come back.
the market will come back. It doesn't mean you came back. The market came back. Because remember, you're still taking out 5% of income. Now you've done that for 7 straight years, and the market came back. The market's back to even, but you're not back to even. You're down still below $1 million on your $2 million. Then all of a sudden we hit 2007, 8, and 9, and the market drops 57%. So imagine you got back to $1 million. Luckily, now you're down to $430,000 in value because it dropped 57%, and you only had $1 million, not $2 million like you started with, and you're still taking out 5% of the 2, which is $100,000. You're running out of money, folks. What, 10 years, 12 years, 13 years? You are broke. It
Right in
doesn't
there.
work.
Well, and whenever anybody tells you, even if the market crashes, it will always come back. We kind of agree because it always has come back. If you look at the Great Depression, the stock market went down 90%. It recovered as long as you weren't taking income out. So as long as someone ever says the market will always recover, they're talking about the market. They're not talking about you if you're needing to use your assets for income. And what did you save this money for? You saved it to use it for income. So you cannot put your assets in jeopardy at that peril because it will now have a direct influence, a direct effect on your lifestyle. And the reason you saved all the money was so that when you retired, you could have a wonderful lifestyle that you didn't have to worry. And by leaving the assets at risk right now, you are putting yourself in a position that you're going to be causing your worry because you haven't now safeguarded those monies.
Yeah, but we could imagine, just flip that around. What if you had met, say, with a firm like ours, and we put together a full plan for you, and you had that same $2 million, and let's say you had a budget of $8,000 a month, and you had $5,000 worth of guaranteed income coming from Social Security. And what if we were able to get you another $5,000 to $7,000 of guaranteed income and still keep money in the market, still keep 7 figures in the market? That way, when the market did go down, you're not using the income off the market necessarily because you have enough guaranteed income to support yourself during those downturns. You're not dragging money out of that side of the portfolio, or you're dragging very little money out of that side of the portfolio. Then if you stay in the market, then yes, it's a different story, but you've got to create a plan to allow you to visually see what happens when the market draws down. What's going to happen to your income needs?
Here's a good example. I just worked with clients. They came in and they saved a lot of money. They don't think they saved enough, but they saved $6 million.
Yeah,
They've done awesome.
A lot.
So he was very aggressive. She's ultra conservative, and I wanted to find a plan that I could put together that balanced it. And he's been doing all his investments. He loves it. So what we did was we put $500,000 into our gold bucket, which is the cash bucket. We kept $3.5 million that he's going to manage ultra aggressively. And we put $2.5 million into the guaranteed income bucket. Now what happens is we were able to put a plan together for them that gives them $5,000 more income than they need per month. And he could lose all the $3.5 million and their plan will never get screwed up. So it's a fail-safe plan that no matter what happens, they're safe.
But wouldn't that be beautiful to have that plan in place if you're a listener right now, knowing that even if the market drops 50, 60, 70%, you're still okay. And if the market goes up 50, 60, 70%, you're still going to participate in some of that gain. And that's what we do for our clients here.
For more information about Peak Financial Freedom Group or to schedule a consultation, just go to our website, peakfin.com. That's peakfin.com. And thanks for watching.